Welcome to this week's Q&A. We've got a very relevant question from one of our viewers in Singapore this week, and it's been asked by many of our Australian expat viewers around the world and relates to the changes to Queensland land tax that was enacted just 30th of June 2022. This person's asked, look, should I be worried about this, quoting the AFR article? And in their particular situation, there's not really anything to worry about, but it is relatively complex, so one has to go through this and look at how these changes actually impact you, because it relates to land holdings in other states. So if you own investment properties in Queensland, but only Queensland, there's no change. If you own investment properties in Queensland, but also have some in one of the other states and territories, then there is a change, and you could in fact face a much higher land tax bill next year. So important to look at how this sits for everyone's own personal situation. Then you've got to look at the ownership. You know, do you own this rateable land in Queensland jointly, i.e. as joint tenants with your spouse perhaps, or tenants in common, and how is that going to impact your assessable limits? You get the exemption up to 600,000 in Queensland for land tax, so important to see how that plays out. And if you look at it from a practical viewpoint, as this person asked, I mean, they have an apartment in Queensland and they have property in other states, but the apartment is, say, one in a boutique building of 100 apartments. And if the rateable land value that building sits on is $5 million, then for the sake of the argument, let's assume the apartments are the same size, that person would own 1% of that rateable land value and be taxed upon that. So as one can see, that's a very small amount. And whether you're paying the maximum rate, percentage rate on $50,000, or not paying land tax or paying a lower rate, it's not going to have any real significant impact to the overall, commercial outcome that you're going to see. The opposite is true though, where people have potentially looked to seek higher capital gains and have bought old houses on large blocks where the rateable land value is obviously far higher, and you own either 100% of that as an individual or a percentage of that if you own it as tenants in common. So here you've potentially got a bit of a double whammy, because not only may you be hit for a much larger rate in land tax if you own property in other states, but the actual quantum will be much larger. And we often find that if you own an older home on large land, your yield is much lower than if you own a modern multi-use dwelling. So, whatever's going to happen could be chalk and cheese depending on your personal situation. So if you are concerned about this, or you'd like to get some more clarity in relation to how it's going to impact you, just reach out, email us or call us, and we'll have someone get in contact with you. And if you found this of interest, then please subscribe to our YouTube channel and click like, and I'll see you at next week's Q&A. I'm Andrew Unterweger from Wise Guru.